Hey, welcome back to The Dive. A possible 75 basis point rate hike, the monetary policy's effect on participation rates, the weakening Japanese yen, earnings season, supply chain, and the U.S. housing market are the topics that our guest will deep dive into today. She's a financial expert, commentator on economic trends, CEO, and chief strategist for Quill Intelligence, LLC. Danielle DiMartino Booth is joining us today. But before we bring you Danielle's interview, do me one quick favor and just go ahead and smash that subscribe button, please. Hey, Danielle, welcome back to The Dive.
Great to be with you again.
Yeah, thank you so much for joining us today. Okay, so earlier this week, St. Louis Fed President James Bullard said that the central bank needs to move quickly to raise interest rates to around 3.5% this year, and says a 75 basis point hike could be an option. Do you think 75 basis points is on the table, or do you see a longer term hiking regime?
So, Bullard keeps dropping these bombs, and, I think that you can't be dismissive of what Jim is saying, because he's kind of the trial balloon, if you will. He is right now he's the in resident Federal Open Market Committee, kind of the maverick, the one who's testing the markets to see what the reaction would be to the idea, to traders and investors idea of that level, and more importantly, rapidity of rate hikes. I don't think that the Fed would do that. I don't think that the aim is to shock the markets, but I do think that the Fed is frustrated that it's been trying to talk down financial conditions to try and make the stock market come down. I know we'll talk about this a little bit later because we have to. They're trying to cool off speculation in the housing market, but they're not doing a very good job just yet, regardless of how tough the talk is. So, to me, at least, being a former Fed insider, it's going to be wait and see. And I think that they will be data dependent, even though they're not saying that today, even though Bullard is saying we think that neutral is 2.4%. That's the rate at which the economy is neither expanding or contracting and threatened by monetary policy. So we think that we can go more than 1 percentage point to 3.5% beyond neutral. I mean, these are kind of big statements given the experience of 2018, when the Fed failed miserably to tighten to that extent, right? They only got to 2.5% before things started to break in the credit markets. So it remains to be seen. The difference between then and now, of course, is that we've got, the latest CPI printed 8.5%. So the Fed has a lot less latitude in trying to be measured in its approach. But 75 basis points, I don't think that that's going to happen. I think 50 basis points is in the bag for May the 4th.
Okay. All right. So I recently spent my winter in Austin, Texas, and I noticed a trend where a lot of food services were largely understaffed. What impact do you feel monetary policy has had on participation rates?
So I think that I think that there's a process through which this has happened. The CARES Act that was signed into law was probably a massive mistake. It will probably go down as one of the biggest policy blunders of all time, paying people $2,500 a month to not work, in addition to what they were being paid with regular unemployment benefits. More importantly, covering people's rents. And people don't speak about this enough, but you were giving people $2,500 a month plus covering a sum that was close to that amount. So the incentives to stay out of the workforce was huge. And when Biden came into office, the further stimulus measures that he signed into law, basically after Trump signed socialism into law, compounded the situation. You increased food stamp coverage by 25% as of October the 1st. Child tax credits were paid out in cash. So you especially have a huge number of working moms who used to be able to send their kids to school. That became prohibitive because of COVID restrictions. Childcare costs went up for the same exact reason that we're discussing food service employees not coming back to work, because these are some of the lowest paid wage occupations in the country. And when you do the math, a single working mom with 2 kids, before a single stimulus check was cashed or deposited into her account, was making the equivalent of $61,000 a year. Probably multiples, especially in the state of Texas, of what her income had been prior to that. It's not a wonder in the world. You have to wait twice as long in Austin, Texas, where I went to school at UT, but it's no wonder that you've got to wait twice as long to get service because people have been incentivized to stay out of the workforce.
Okay, now the Bank of Japan has offered to buy an unlimited amount of 10-year government bonds at fixed yields for the first time this month. And earlier this week, the Japanese yen tumbled to a fresh 20-year low against the US dollar. What do you think is happening here?
Well, we have to keep in mind that among more developed nations, Japan and followed by South Korea are the largest net importers of natural gas in the world. So it's very problematic when you have the yen as weak as it is, because you're having to pay more, relatively speaking, in your currency to get that essential import into the country, whether you're heating a home or cooling a home. So that is one of the impediments that faces Japan. And they're trying very hard to control the situation right now by saying we're going to cap the 10-year yield at 0.25% by buying unlimited amounts of Japanese 10-years. But we've had maybe a few days of calm in the yen trading markets, but boy, it has been nothing like I've ever seen. And for generations now, we've discussed the great experiment of Japan having gigantic levels of debt to GDP north of 300% and saying it's okay, it's a contained sovereign debt universe. They'll be able to control the yen, they'll be able to control borrowing costs. This is the first time in my lifetime as an investor that I've seen Japanese authorities, the Ministry of Finance, the Bank of Japan, begin to lose control. So this is definitely something to pay attention to. It's an outgrowth of US fiscal stimulus gone wild that ignited inflation worldwide that's been terribly exacerbated by Russia's invasion of Ukraine.
Okay, now as we're going through earnings season, we're seeing evidence of companies that are not sure about the outlook and stockpiling. Do you think that this could have a deflationary impact at some point?
We're actually seeing in several of the New York Fed, the New York Fed, the Philadelphia Fed, the regional Federal Reserve manufacturing surveys. They query operators as to where they feel inventories will be in 6 months. And these measures looking 6 months out have literally crashed, meaning we know that we're going to have enough on hand and we're running into problems with pricing power, passing along the cost of buying these, stockpiling these inventories at record high input levels. So again, we're living in rarefied times, which it's difficult to convey to you. You're too young, but we're living in rarefied times because there have been several generations of operation managers who haven't had to deal with the cost of carrying inventory. And we're hearing that warehouse space is literally running out in the country, meaning we really are seeing a lot of stockpiling. Companies might be forced to cut costs in the form of cutting labor and cutting prices. So we could be looking at something that is deflationary building up. Great question.
Okay, so now Chinese ports are operating at minimum capacity due to COVID-related restrictions imposed by the government. How do you think that this will affect the U.S. supply chain?
Well, right now, because of what we just discussed, because inventories are so high, there's not necessarily the dramatic need for Chinese imports that there was when U.S. consumers had a lot more cash in their hands. That demand pull impulse isn't what it was last year, say in 2021. That being said, there are certain essentials that many U.S. manufacturers absolutely need that are being held up because we do still exist in a global supply chain. So we have begun to hear rumblings from certain manufacturers and on certain earnings calls about, the supply chain disruption is because of the zero COVID policy in China has already started to affect where we are in terms of our ability to operate. So it's a to be determined situation. All I can tell you is that it's a margin squeeze at a time when there are many other elements that are also squeezing profit margins.
Okay, now lastly, before we let you go here, I want to come back and touch on the housing market again. The 30-year fixed mortgage rate recently crossed 5%. What are your thoughts on what's going on in the US housing market?
So, it depends on which gauge you use, but from a year ago to now, your average mortgage payment, given your average house price, which is at a record high, has increased by about 30%. That's a huge leap. If it wasn't for investors' gigantic footprint in housing, and we know that investors are about a third of all new and existing home transactions, I dare say that housing would be much weaker than it is, simply because affordability has become untenable for especially first-time entry home buyers, millennials, people who've been waiting on the sidelines for years. They're finally starting to get into the housing market after COVID, when there's an exodus from urban areas into the exurbs, into Boise, Idaho, of all places. All of these towns, Austin, Texas, that was on fire. Now you've got the 30-year fixed north of 5%, pinching affordability even more, especially for this demographic, which is the largest generation that's alive in the country.
All right, well, that's all we have for you today, Danielle. Thank you so much for coming on and sharing your thoughts with us. It's been a pleasure.
Absolutely, thank you.
To our audience at home, thank you so much for tuning in today. We'll be back again tomorrow, so you might want to turn that notification bell on so you don't miss out.